I'm Stanley Kahn. Thank you for taking the time to listen to my approach to wealth management in the current economic environment. There are two driving forces at work in our economy affecting the business of wealth management. The first is a decade of low interest rates, and the second is information technology. When the level of interest rates was near 10%, and the stock market had an expected return of 17%, investors did not pay much attention to total expenses of 2% from the combination of a 1% expense ratio on individual mutual funds and an additional 1% advisor fee. But these expenses mean that an investment by your advisor today in a long-term bond fund with a yield of 2% will have a net yield to you of 0%. Advisor investments in money market, short-term treasury funds, and funds with excess cash yielding less than 1% will result in a negative net yield to you. Do you really want advisors to manage any significant amount of your cash in short-term low-risk bonds? Furthermore, in recent years, there have been periods of both low interest rates and all-time low stock market volatility. That implies a low stock market risk premium. In these environments, the expected return on stocks may be 5 to 7%. If total expenses are 2%, you should think of that as reducing your expected return down to 3 to 5% and receiving considerably less compensation for stock market risk. The internet is not new, but the ability to efficiently download and integrate sufficient data on personal accounts, market, and security-specific data is relatively new. Conflicts of interest have the Labor Department and SEC working on fiduciary rules to protect investors. That is shifting the investment business towards advisor fees over commissions. Managerial risk involves advisors and fund managers deviating from benchmarks to enhance returns in order to justify their expense ratios and fees. The empirical evidence of success, however, is generally weak at best, and Bernie Madoff Ponzi schemes at worst. Investment education is required to protect yourself. The industry disruption is upon us. Low-cost index funds have now gathered more assets than active funds. The recent offerings of zero expense ratio mutual funds and zero commission trading are evidence of more industry disruption. These are loss leaders to cross-sell investors into the more profitable advisory business. Competitive forces in the advisory business are reducing fees, but this trend will not continue without investment education. It is an extremely valuable innovation to have low-cost investment alternatives, but the difficult issue that remains is how to construct a portfolio, monitor it, and revise it when appropriate. I am advocating enhanced information and a disciplined approach to do-it-yourself wealth portfolio management. My perspective is in both the theory and practice of investment management. 25 years as an academic and consultant, and 15 years to practice what I preach and innovate as Director of Research and Co-Director of the Investment Management Group at an institutional investment firm where sophisticated clients were public and private pension funds, central banks, hedge funds, mutual funds, and retail banks. For the past 19 years and ongoing, I have also been the editor of the Journal of Fixed Income that publishes contributions from both academics and practitioners in order to improve the performance of portfolio managers. After I retired in January of 2014, I began solo backpacking in Colorado and on the Appalachian Trail in North Carolina, Tennessee, and Virginia. I read lots of non-finance, non-fiction books for pleasure and information. Even at my advanced age, skiing in Colorado in the winter is still exhilarating. It seemed like a full-time job to design, build, and move to our dream home in the mountains of Colorado. We did it. I call it my final resting place. This retirement life is awesome. Then, my 30-something married children asked me to help them with their investments. After listening to my lectures on risk-return trade-offs, in exasperation they replied, "Dad, just tell me what to do. Better yet, please do it for me." Okay for now, but this will not work when I am gone. It became clear that I had one more mission to achieve. Retirement has been an unexpected third career with the objective of providing families with the concepts in the form of a book and tools in the form of a web application for lifetime wealth management. The combination of concepts and tools make the process feasible for anyone sufficiently motivated. It is not just about keeping expenses low. It is also about obtaining and maintaining wealth portfolio objectives. A 30-something dual-career family will likely have at least 11 investment accounts with a lot of potentially uncoordinated risk exposures and objectives. There are lots of moving parts in multiple 401ks, rollover IRAs, 529 plans, custodian accounts, taxable brokerage accounts, bank savings accounts, and checking accounts. How do all these pieces fit together? A glance at their 401k accounts revealed serious issues: limited investment choices, overlapping multiple risk exposures, high expense ratio funds, administrative expenses, difficulties in rolling over a 401k to an IRA. How can they work around the worst offerings in an aggregate wealth portfolio context? My initial approach was to create a spreadsheet for each family. Each account had a row for each security with its descriptive information: ticker symbol, security name, price, number of shares, allocation percentage to cash, bonds, and stocks, yield, expense ratio, cost basis, and unrealized gain or loss, and its risk exposures. For stocks, it was U.S. versus international, large, mid, and small capitalization distribution, value blend growth distribution, and sector distribution for diversification. For bonds, it was U.S. versus international, credit rating distribution for default risk, maturity structure for interest rate risk, and bond sector distribution for diversification. That is one long row of security information. Then I added real assets, including homes and autos, non-traded illiquid assets, including private business investments, private stock, and lending, liabilities, including mortgages, auto loans, and credit cards. Then aggregating each column across all assets and liabilities into a wealth portfolio dashboard of risk dimensions that compared them to a customized benchmark. The process of recommending portfolio revisions required gathering the same data on many potential new investments. The analysis was extremely useful, but the process was very labor-intensive and time-consuming. I could not expect anyone to spend this much time on the setup. I want them to focus on portfolio selection decisions. If it was to become user-friendly and time-sensitive, the process needs to be automated. As Director of Research, I was responsible for providing updated analytics to traders and portfolio managers every morning. Now I need to do something similar but designed for personal wealth management. Steps 1 to 4 outline the automated capabilities of a web-based application I would ideally want on my desktop. After signing in, auto-update all current information on my account assets and liabilities to display a full balance sheet. Note that net worth is the wealth portfolio objective to manage. Simultaneously, update from data sources all the risk dimension information on each asset and liability underlying the user's balance sheet and that of a customized benchmark to display in an aggregate wealth portfolio dashboard. A set of gauges will help monitor the deviations from the benchmark. In order to make decisions on matching or tactically deviating from the customized benchmark requires more market information. What most professionals do in the morning before the market opens is look at a daily market analysis. What happened overnight? What are the changes in relative values of assets and sectors? Is the compensation in the mortgage or corporate bond market sufficient for its risk and my position? What is the incentive to increase or decrease my equity exposure, and how? I need an auto-updated market information dashboard. Finally, I need an efficient way to evaluate the size of any position changes on my wealth portfolio risk dimensions before executing any trades. Revision mode would allow me to evaluate what-if changes relative to my current portfolio and benchmark deviations. This is an essential tool to efficiently construct, monitor, and revise my portfolio. Once a suitable set of decisions is reached, trades are executed at your financial institution and can be observed afterwards in the refreshed web application. The application is a set of tools for decision-making only. The application will not have any control of personal accounts. After consulting with my sophisticated technology partners, they indicated the information sources were available and that they could build it. Thus, we formed Ripsaw LLC 2 years ago and are now releasing Ripsaw Wealth Tools at the same time as my ebook, Do-It-Yourself Wealth Management. Information on both are available at ripsawwealth.com and ripsaw.co. Now let's get back to providing the concepts in the form of the ebook, Do-It-Yourself Wealth Management. After the motivation in the preface and introduction, the book is divided into 4 parts. The chapters are reasonably independent so the reader can skip around. If a topic is less relevant or confusing to you, move on. The sections are mostly in ascending order of difficulty. Part 1, Quick Start, is meant to get you up and running on the task of wealth management with some no-brainer decisions. I will cover the case study in this presentation. Part 2, Financial Decisions, explores many common issues in a disciplined investment process, including debt, liquidity, insurance, and retirement. Part 3, Investment Strategies and Evaluation, discusses the sources and interpretation of financial data, investment strategies, and how to evaluate them. Part 4, Life, Liberty, and the Pursuit of Happiness, is for my grandchildren. It's about how they can employ the same investment decision-making process and logic in the rest of their personal lives. There are several important underlying concepts in this book to keep in mind. The first concept is opportunity cost. It is larger than just saving on annual fees. The preface of the book has an example that in 30 years of investing, 1.8% in fees beyond a low-cost index strategy will be 22% lower in wealth accumulation and 33% lower from not being able to reinvest those lost excess fees. The second concept is that most investment products cannot offer you more than the market already does, but after fees can result in much less. For example, I looked online for an annuity quote for a 65-year-old male to receive $2,500 per month for his remaining life. The quote was $512,287. The relevant question, however, should be, what is the internal rate of return for that annuity investment? The expected life of a 65-year-old man from the Social Security actuarial table is 17.84 years. The internal rate of return on this investment for 18 years is 0.61%. But a treasury bond with a duration of 18 years is 2%. That means the fees are eating up most of your expected return. Therefore, you can do much better with a do-it-yourself annuity costing only $453,000 for the same $2,500 per month. That is a savings of nearly $60,000. You can also gain by investing in high-quality corporate and mortgage-backed securities, as the insurance companies do. That will extend the life of your annuity another 8 to 11 years for the same price, and still have a bequest to your spouse and heirs if you don't exceed your own remaining life forecast. A do-it-yourself annuity can also be easily altered if your life circumstances change. The third concept is to unbundle and manage portfolio risks. For example, the bond market has three major risks: interest rate changes, default, and prepayments. The market requires additional promised compensation for default and prepayment risks in the form of more yield or yield spread to interest rate risk matched treasuries. Professional managers that have their performance measured against the investment-grade bond market index typically tilt their portfolios away from treasuries toward the spread products of MBS and corporate bonds that have higher yields. The correct expectation for long-term investors is that, on average, they will earn a higher expected return and beat the benchmark. No special information is required here. It is just that you are taking advantage of your position in the marketplace as a long-term investor that is more short-term risk tolerant. Hence, you can do the same as the professionals by unbundling the aggregate investment-grade bond index with separate investments in the three-component index funds that represent the Treasury, MBS, and corporate subsectors. Then you can tilt your portfolio with investment weights that differ from the composition of the benchmark. The fourth concept is investment discipline. Always act with fiduciary responsibility as a source of careful risk-taking requiring sufficient compensation. If you do not have special information on security valuation, it is not likely you will beat the professionals with all their resources. But you can use portfolio tilts to take advantage of your place in the market as a long-term investor and liquidity provider during market stress periods. If you do have special information on individual securities, define the magnitude of under or overvaluation, the time by which you expect the market to realize your valuation, size your position based on degree of confidence in your forecast and risk tolerance. Then have the discipline to sell when the price reaches your prediction and move back to the more diversified benchmark with the sale proceeds or for another mispricing opportunity. Performance relative to a benchmark is an essential part of the investment process for feedback in order to measure past performance and improve future performance. The fifth concept is downside risk management. That is always important, but a critical strategy near and in retirement to lock in a standard of living. Let me overview here the list in the chapter on no-brainers. Much more detail is available in the book. The first no-brainer is to maximize tax-deferred retirement contributions. Besides good savings discipline, the immediate tax savings of a $15,000 contribution in a 35% marginal tax bracket is $5,250. That could be used for an additional investment in a brokerage account or for a down payment on a home. An employer with a matching program is the ultimate no-brainer. During my time at the University of Michigan, a 5% of salary contribution by a professor to the 403B plan was rewarded with another 10% contribution from the university. That is a 200% instantaneous return with no risk. As finance department chairman in the mid-1980s, I made it clear to new faculty, those fresh PhDs, that not taking this investment opportunity because of a cash flow excuse would result in removal from the classroom as unfit to teach finance. There are enough short-term borrowing opportunities to finance this investment. The second no-brainer is to roll over a company tax-deferred plan to a traditional IRA at every opportunity in order to get away from plan restrictions and high-cost investments. When moving to a new job, do not roll over your tax-deferred plan to a new employer plan with another set of restrictions. You will have more choices in a self-directed IRA. You should be in total control. The third no-brainer is to use risk-free tax minimization strategy. For example, after an overall asset allocation is determined, locate the more tax-efficient holdings like low dividend, high capital gain, and tax-exempt funds to your taxable brokerage accounts, and high dividend and interest rate-bearing holdings to your tax-deferred accounts. This is why having the same portfolio in all accounts is inefficient. The fourth no-brainer is to reduce the cost of implementing your financial plan at every opportunity. Never purchase a fund with a load or sales charge. The load is payment to a middle person, a broker, for helping you pick a good fund. What incentive does the broker have to act in your best interest when their compensation increases with the sales charge? Front-end load charges are typically in the range of 3 to 8.5%. That means you have to make up this charge just to break even. That may take a long time in this low interest rate environment. This is an unnecessary expense when there are equivalent funds in terms of investment exposures and performance which have no load. Beware of back-end loads that disguise the charge by having you pay the same load over time and in an exit fee. Do you really want to pay marketing, advertising, and distribution costs, those are 12B1 fees, for the fund to get other clients? I don't think so. The fifth no-brainer is to avoid target date funds. An investor is assumed to have a high risk tolerance with many years ahead to earn the higher average risk premium in stocks. Such a fund will begin heavily overweighted in stocks and systematically reduce the stock weight over time into bonds and cash. But target funds are not all alike. They each have their own costs and investment risks that are not likely to fit your unique personal goals. The good news is that you don't need target date funds to achieve a dynamic, time-dependent risk strategy. You can create your own target date wealth strategy with full knowledge of all the assets you own at a lower cost. The sixth no-brainer is to avoid annuities. The reason to stay away from annuities is that you pay large fees to a salesperson and an institution providing these relatively simple bond portfolio strategies that you can easily replicate on your own at very low cost. A do-it-yourself annuity example is demonstrated in the Downside Risk Management chapter of my book. The seventh no-brainer is to never buy whole life insurance. It is a bundle of life insurance and investments with heavy fees and managerial risk. Unbundle with low-cost term life insurance and do your own low-cost investment strategy. Furthermore, it is actuarially clear that the probability of death in the next year is higher as you age. A constant premium is hiding the fact that underlying cost of your contract is increasing over time. Why overpay early when you are better off using the money for wealth accumulation now? Then you can self-insure when wealth accumulation is sufficient and the premiums are very high. Note that wealth management involves all assets and liabilities in unique family circumstances. Include your primary home, vacation home, and investment property assets. Include mortgage, auto, student, business, and unsecured loan liabilities. Include wage income, business income, and private investments. Include vested and unvested employer restricted stock and options. And consider not only your investment horizon, but that of your family, your heirs, and beneficiaries. Chapter 4 is a case study for a friend that asked me to review her wealth portfolio on June 30th, 2016. Eleanor's situation at the time is that she recently sold her business and is working part-time at a new company with a tax-deferred plan. Her current marginal tax bracket is 20%. She's a single mom, age 57, with 2 children and 529 plans. Eleanor is a homeowner and has a retirement plan in 5 to 8 years. She has 2 advisor accounts, each with a 1.15% assets under management fee. The first is a traditional IRA with $677,000 and an investment account with $205,000. After reviewing Eleanor's statements, I made the following notes. $10,150 per year in advisor fees. That is an opportunity cost to save and invest. The number of funds in her IRA is 35, and 16 funds in her brokerage account. That is unnecessary complexity. There's no indication of fund expense ratios on statements, which implies a lack of transparency. Is 75% stocks in the managed accounts appropriate? High-yield bonds and accounts overstate expected yields and are not a good diversifier due to their high correlation with stocks. Why are municipal bond funds in the portfolio? Eleanor's marginal tax rate is 20%, not 39.6%. And she is actually losing money on the municipal bond funds. The SEC yield on the fund is 1.17%, which is less than the 1.59% in fees from the combination of 1.15% advisor fee and 0.44% fund expense ratio. Furthermore, Eleanor is losing money on cash in all funds. The current 3-month T-bill rate is 0.26%, which is considerably less than the 1.15% advisory fee plus an expense ratio. Why pay an advisor to manage your cash? The investments among accounts are not tax efficient. There is significant managerial risk in active fund investment managers and the advisor. Furthermore, the company tax-deferred account is 100% invested in a balanced fund. That is not balanced. It is 85% in stocks, and the average bond quality is below investment grade at BB. And it has a 1.14% fund expense ratio plus an administrative 0.72% net asset fee. In order to evaluate a portfolio, we need some investment discipline. This is attainable with a benchmark strategy that must be established to measure suitability and performance. Step 1 is to define a low-cost, well-diversified, investable set of market proxies for cash, bond, and stock benchmark portfolios. Step 2 is to define a strategic asset allocation by selecting the percentage invested in the cash, bond, and stock market benchmark portfolios consistent with investor objectives, including risk tolerance. Step 1 involves selecting mutual funds, or ETFs, that is most representative of the 3 sectors. Note the representative sector fund choices and allocations. This default set of proxies is for a US-centric investor. A global-centric choice is also available. However, the user can customize by expanding the bond and stock sectors with more fund choices and allocation percentages. Step 2 involves selecting a strategic asset allocation for the percentages to be invested in each of the cash, bond, and stock proxy sectors, consistent with investor preferences and risk tolerance. Eleanor chose 45% in stocks, 4% cash, and 51% in bonds. We can now analyze Eleanor's June 30th, 2016 balance sheet and wealth portfolio dashboard in Ripsaw Wealth Tools. Note the interesting highlights. The current market value net worth in the dashboard does not match the balance sheet net worth. In a wealth level context with real estate, the stock percentage of 30% does not appear that large. Why is the bond allocation negative? Yield so low and expenses so high? The discrepancy in net worth numbers is because the balance sheet treats the home mortgage loan as outstanding balance or book value, while the Ripsaw dashboard calculates market value that includes the value to the homeowner at the current mortgage refinance rate. If current rates are lower than what Eleanor is paying on a high-rate mortgage, she is losing the present value of those savings. Now we can see the stock percentage appears low due to a relatively large home value and a large, probably inefficient cash position. In a wealth portfolio context, a mortgage is a bond. The negative bond percentage is because the borrowing or short position of the mortgage is greater than all the long bond allocations in Eleanor's investment portfolio. In a wealth portfolio context, the yield is very low relative to the benchmark because of the mortgage payment outflow and the inefficient use of cash at very low interest rates. Separately, expenses are extremely high relative to the benchmark. A touch of the home auto icon takes out real assets and associated loans to focus on the investment portfolio. Now we can see the positive, although underweight, investment in the bond sector, and a better, although still considerably less than benchmark, asset yield. Now we can proceed with mortgage, company IRA, and managed investment decisions. Eleanor's original $554,000 mortgage is a 15-year, 5.375% fixed rate that has a remaining balance of $349,708 after 7 years. The current market rate on a mortgage for the remaining 8 years is 3.5%. Eleanor is losing a present value of $25,764 by not refinancing the loan and paying the lower rate for the remaining 8 years. Since she could easily qualify with a 33% loan-to-value ratio on her home, refinancing seems like a no-brainer decision. However, Eleanor has already accumulated significant wealth and is getting closer to retirement with a shorter investment horizon and less risk tolerance. Hence, considering paying off the mortgage completely rather than refinancing is also an option to save on the rate. In Ripsaw's revision mode, paying down the mortgage from her savings account increases Eleanor's wealth portfolio market value by the same $25,764 as in a refinancing, but also increases yield close to the benchmark and improves the bond allocation percentage. Now that we have taken away a lot of the investment portfolio cash overweight, the stock allocation overweight is revealed, and the bond allocation is still underweight. Now we can focus on investment mode. Note the drop in revised aggregate value to $1,010,000, resulting from using the savings account to pay down the home mortgage. The current company IRA is invested 100% in a balance fund with a 1.14% expense ratio, but is not really a balanced strategy. The lowest expense ratio available on the list of fund choices in the company plan is 0.57% for an S&P 500 index fund with little managerial risk. Therefore, we use Ripsaw's revision mode to sell the balance fund and buy the index fund. The issue to focus on next is which stocks to sell and use the proceeds and excess cash to buy which bonds. Looking at Eleanor's managed IRA, there are fund expense ratios well over 1%, high account management fees, and excess cash allocations in the funds. And much the same problems exist in Eleanor's managed brokerage account. The portfolio reconstruction can be achieved in a three-step asset allocation process. Step one is that given that there are no significant capital gains subject to tax, Eleanor can liquidate the current IRA and brokerage accounts and move all the cash to new Vanguard rollover IRA and brokerage accounts respectively. Step two is that Eleanor's benchmark cash allocation is near $40,000, and she only requires $20,000 in ready cash. Hence, she can move $103,000 from her savings account to her new Vanguard brokerage account for more investment choices. Step three will be to determine the portfolio revisions. Completing the mortgage paydown, company IRA revision, and the transfers from the liquidated managed accounts to new Vanguard accounts result in an investment portfolio that is almost all in cash with no management fees, no bonds, no mortgage, and only the small investment in the S&P 500 index within the company tax-deferred plan. Now the portfolio selection process will proceed more quickly by predetermining some criteria to build Eleanor's efficient portfolio. Number one is to use low-cost index funds for specific factor exposures without managerial risk. Hence, there will be a preference for index funds, especially ETFs. Number two is to allocate more of the higher dividend yield stocks and bonds to tax-deferred accounts. Number three is to have low interest rate risk in this extremely low rate environment with short to intermediate term bonds. Number four is that given the insufficient below investment grade default risk premium, select up in quality corporate bonds. Number five is to add mortgage-backed securities for diversification and compensation. Consider 6 transparent funds that provide clear risk exposures, diversification, and tax efficiency with the potential to closely match Eleanor's customized benchmark. Note that we are unbundling the large cap sector into the equally dollar-weighted combination of the large cap growth ETF, VUG, and the large cap value ETF, VTV. Together, they closely match the total large cap index, but can be more tax efficiently allocated by having the lower dividend yield growth fund in the brokerage account and the higher dividend yield value fund in the tax deferred account. This is unbundling for tax efficiency. The low dividend small cap ETF is also used in the brokerage account, while most of the bond fund dollar allocations are in the tax-deferred IRA account. Also note that all funds employed have relatively low expense ratios with clear risk exposures, and as index funds, little to no managerial risk. Since we want more in bonds than stocks and tax efficiency, let's start with a 60% bond and 40% stock allocation in the IRA account with equal weights within the sectors. That is, 20% in each of the two stock funds and 30% in each of the two bond funds. In the brokerage account, we want to closely match the dollar amount in VUG as we have in VTV in the IRA account. This is for tax efficiency, so no tilt is intended. 45% in VUG in the taxable brokerage account is close enough for this first pass. 20% in VB is intended to get the necessary small cap exposure, and the remaining 35% in VFSUX for short-term investment grade bond exposure. This first pass revised portfolio looks pretty good, close to the benchmark for the cash, bond, and stock allocations. But the composition of the stock portfolio is far off. The stock portfolio is clearly underweight U.S. stocks and overweight international stocks. It is also underweighting large cap stocks and overweight mid cap stocks. The initial bond allocation appears to have succeeded in reducing the portfolio default risk considerably from the managed account portfolio and even higher quality than the benchmark, with a lower allocation to the BBB investment grade sector. The stock portfolio overweight in international can be reduced by selling 6% of the total international fund, VXUS, and buying 2.5% more in the VTV value ETF. The remaining 3.5% can be allocated equally to the bond funds, with 1.75% to the VFSUX short-term investment grade fund and 1.75% to the VFIJX Ginnie Mae fund. In order to match the dollar allocation of VTV in the IRA account, we raise the allocation to VUG plus 4.5% to a total of 49.5% in Eleanor's brokerage account. That is achieved by reducing the short-term investment grade fund VFSUX by 2.5% and the previously slightly overweight small stock allocation by 2%. The investment portfolio dashboard and the stock portfolio composition are now close to the benchmark. Note that because of the overlap of mid-cap stocks in the small cap and large cap funds, there was no need to include it as a separate mid-cap fund. And we maintain the intended short-term up and quality bond strategy. We can now review Eleanor's wealth portfolio dashboard to see if her objectives have been obtained. Eleanor's wealth portfolio meets her investment objectives for risk tolerance and cash flow. There is significantly less bond default risk and interest rate risk in her portfolio. She eliminated the municipal bond and excess cash fund money losers. The stock and bond subportfolios obtain preferred risk exposure and diversification objectives. Eleanor's yield is up $24,060 and expenses are down $13,639 for a net gain of $37,699. Improved after-tax returns with IRA versus brokerage allocations. eliminated advisor and fund managerial risks, and replaced them with full transparency. Monitoring and revision are ongoing, especially as retirement approaches. The frequency of portfolio monitoring and revision depends on the complexity of your portfolio and its sensitivity to market events. Although a regular monthly review is good practice, a life change, a major cash investment inflow or outflow, or the emergence of significant market volatility should instigate an immediate review. Here is a minimal checklist for portfolio monitoring and revision decisions. First, review investment objectives. What are your relevant life changes that may affect your risk tolerance, health, income, family goals, and obligations? Adjust your benchmark strategic asset allocation accordingly. Review the market environment. How has it changed? Start with the Treasury yield curve. What are the risks and compensation available in the major sectors of the bond and stock markets? Any change in your real assets, loans, and private business opportunities? Compare your current wealth portfolio allocation to your benchmark and consider revision alternatives that are consistent with your objectives and the current market environment. Review the overall as well as the detailed allocations. The overall stock, bond, cash, and real asset allocation decision. Then you can drill down in your stock portfolio composition decisions. For diversification, you'd be looking at U.S. versus non-U.S. and emerging markets, as well as your stock sector distribution. For factor tilts, or not, you can look at large, mid, and small capitalization distribution, as well as the value blend and growth distribution. Drilling down in your bond portfolio composition, diversification in U.S. versus non-U.S. and emerging markets, as well as diversification in your bond sectors. Then analyze your rating distribution for default risk and maturity distribution for interest rate risk. When satisfied, implement revision decisions. Now let's work on unbundling the risk and rewards of benchmarks for asset allocation. Here we are replicating the investment grade bond market proxy BND. There are three major risks in the index: default risk in corporate bonds, represented by VTC, and prepayment risk in MBS by VMBS. Both of these sectors have interest rate risk, but can be managed at the portfolio level with the Treasury sector combination of short, intermediate, and long-term Treasury funds, using VGSG, VGIT, and VGLT. The replication weights selected indicate a close match to the benchmark, default, and interest rate risks. The overweight in MBS was employed to represent its small securitized relatives in the ABS and CMBS sectors in the benchmark. The overweight in corporate bonds is to get that BBB credit sector up to the benchmark level from the small underweight in the government-related sector. Now we can do what the professionals do to beat the benchmark without any special information or insight. Reduce the Treasury rate by 20% and add 10% to each of the corporate bond and mortgage sectors. For professionals or individuals with long-term objectives, on average, they will earn the risk premium. However, short-term tracking error can be high. The exact percentage spread product overweight is a function of investor risk tolerance. As we can see, the down in quality within the investment grade sector is achieved with an underweight in AAA and overweights in A and BBB subsectors. The sector rotation is achieved with overweights in MBS and corporate bonds and an underweight in government bonds. There is still the decision of what interest rate risk level to create. If it is to maintain the same level, we need to understand that fixed income securities classified by maturity alone is not a sufficient measure of interest rate risk. A 30-year mortgage actually has interest rate risk that is closer to an intermediate-term treasury at origination and more like a short-term treasury if interest rates drop dramatically and prepayments speed up. The risk of rising interest rates declines when bond cash flows are received sooner because they can be reinvested at the new higher rates. The fact that an MBS is paying down principal in each monthly payment is a clear indication that an MBS has less interest rate risk than a 30-year Treasury bond with only one final principal payment at the end. Furthermore, prepayments on the underlying loans in an MBS fund will further reduce its interest rate risk. Corporate bonds also have less interest rate sensitivity than comparable maturity treasuries. As treasury rates decline from negative information on the economy, the increase in the probability of default expectations on corporate bonds is observed in spread widening to treasuries. This dampens the expected price increase from a drop in treasury rates. When good information on the economy arrives and treasury rates increase, the decline in corporate bond prices are mitigated by a lower probability of default expectations. Hence, corporate bonds have less price sensitivity to changes in the level of treasury rates than a maturity-matched treasury. Therefore, the appearance of underweighting the 3 to 5 and 5 to 7 year maturity sectors by selling the short-term and intermediate-term treasury funds to overweight the MBS and corporate bond sectors will actually maintain a similar level of interest rate risk as the benchmark. If our objective, however, was to lower interest rate risk, we could fund more of the MBS and corporate bond purchases by selling the long-term treasury fund. Increasing net interest rate risk could be accomplished by funding more of the MBS and corporate bond purchases by selling more of the short-term treasury fund. One could also unbundle the corporate bond sector into short-term, intermediate-term, and long-term corporate bond funds for more control over both interest rate risk and default risk by maturity. Tactical asset allocation tilts to stock factors are common strategies. Consider a disciplined approach to a small cap overweight, a capitalization replication for the total U.S. stock market benchmark VTI, with the selected weights of 80% in the iShares Core S&P 500, 12% in Vanguard Mid Cap ETF, and 8% in the Fidelity Small Cap Fund, replicates the capitalization, value blend growth, and sector distributions of the benchmark well. Note that we selected the Fidelity Small Cap Fund because its composition was over 77% in small cap stocks. That is, it represents more of the small cap exposure we are interested in. Other funds with small cap in its name have considerably less exposure to the subsector we are interested in. Here is an example of a 12% overweight in small cap from a 10% reduction in large cap and a 2% reduction in mid cap funds. Note that we get the desired small cap overweight and large cap underweight without affecting the value blend growth and sector distributions relative to the benchmark. We isolated the trade. In order to accomplish multiple factor control tilts for small cap and value simultaneously, it is useful to replicate the benchmark with 6 funds. For example, use a growth and value fund for each of the 3 capitalization classifications. As you can see, the weights on the 6 funds creates a replication that is close to the benchmark in the capitalization, value blend growth, and sector distributions. Furthermore, Note that we are now using the dollar and percent difference from the benchmark for fine-tuning our tilt weights. Now reducing large cap growth by 8%, 2% less in mid cap growth, and minus 0.5% in small cap growth, we can add 9% in small cap value and 1.5% in mid cap value. The desired result of an underweight in large cap and growth is offset by the overweight in small cap and value, without affecting the sector diversification or the mid-cap and blend components of the stock portfolio. Again, we isolated the combo trade. I enjoyed reading the recent AAII article on ETFs. It seemed like a good exercise to model AAII's asset allocation model for a moderate investor and see what the intended and maybe unintended risk exposures might be revealed. The 70% diversified stock portfolio appears to underweight large cap in favor of overweighting mid and small cap stocks, with a substantial percentage of non-US developed and emerging market stocks. The bond portfolio recommendation is all intermediate term. I selected representative ETFs from the list for each recommended stock and bond subsector to use in Ripsaw Wealth Tools. It is interesting to note that there was no return given to the Treasury ETFs during the stock bear market, where evidence of a hedge could be observed. The benchmark bond portfolio proxy I use, BND, is 100% investment grade bond market. The stock market portfolio is comprised of 28.57% in total non-US international stock fund, specified in the AAII asset allocation, and the remainder 71.43% in the US total stock market fund. The strategic allocation for the benchmark is set forth as indicated by AAII as 70% stocks and the 30% remainder in bonds. As expected, when applying the AAII allocation weights to each AAII recommended sector fund, the portfolio dashboard indicates a close to benchmark allocation across cash, bonds, and stocks, with low expenses consistent with the constructed benchmark setup. While the general allocation theme appears to be underweighting large cap and overweighting mid and small cap, the intended magnitudes are not obvious. What is the magnitude intention of the 10% allocation to small stocks? Is it a small stock weight for the whole stock portfolio of 10% over 70% or 14.28%? Or is it 10% over 50%? Equal to 20% of just the US stock portfolio. The International Stock Fund has a 5.83% in small stocks, and the Emerging Market Fund has 4.79% in small stocks. Will these lower than benchmark small cap weights be diluting the intended small cap overweight? It is actually the overlap in capitalization categories within the mid and small cap funds selected that will determine the magnitude of capitalization exposures at the aggregate portfolio level. Note that the VB Small Cap Fund only has 40.28% in small cap stocks and 59.26% in mid cap stocks. But because of the combination of overlap in small cap in the mid cap fund and low allocation of small cap stocks in the international funds, the aggregate small cap stock allocation is approximately 14%. That would be very close if the small cap intention was for the total stock portfolio 10% small cap divided by the 70% stock allocation, or 14.28%. But well underweight a U.S. portfolio intended allocation of 10% small cap, over 50% U.S. total, or 20% plus what is in the non-U.S. stock funds. The important point is that the name of a fund is not sufficient to determine its risk exposures. Earlier, we used a small cap Fidelity fund with a small cap allocation of more than 77%, while the Vanguard small cap fund recommended here for small cap exposure is only 40.28% in small cap. These deviations are likely to result in significant tracking error risk relative to the benchmark. The message is that the actual composition of the fund choices must be analyzed not just by the name indication. The Ripsaw methodology allows the user to drill down into the composition of each fund investment and its effect on your aggregate wealth portfolio in order to make sure your intended risk exposures are realized and any unintended risk exposures are avoided. It is good to observe that the strategy did not distort the value blend growth distribution. But the underweight in the large cap technology sector stocks, underweighted Microsoft, Apple, Facebook, Amazon, Netflix, and Google, all of whom have performed exceedingly well. That is why measuring performance relative to a benchmark is an essential feedback loop in the investment process to improve performance. For example, is the rationale behind a small stock overweight still the same and consistent with the many decades of data that supported it? The economic rationale has been to have access to the enormously successful large cap stocks we see today when they were small stocks. But in the last decade, the great success stories did not go public until they were already large cap stocks. Furthermore, if market participants believe there is an abnormal profit in small stocks from past data beyond their expected risk premium, its price will be bid up to the point where future excess returns will no longer exist. We still want to have the diversification benefit of a small cap allocation, but an overweight needs continuous reevaluation and justification. There are two main takeaways from a bond portfolio that is 100% in intermediate term treasuries. The first is that underweighting of investment-grade corporate bonds and AAA-rated MBS leaves long-term investors losing the opportunity to earn their respective default and prepayment risk premiums. Secondly, a concentrated middle maturity structure of treasuries that overweights the 3 to 10 year segments and underweights the wings is giving up the hedge against deflation and much of the flight to quality hedge benefit in long-term treasuries. Furthermore, underweighting the front end of the treasury spectrum gives up the hedge against increases in inflation to more quickly roll over principal and interest payments at higher yields. That is a significant deviation from the latter benchmark neutral strategy. It is a bet that can be measured with future performance relative to the benchmark. Observing Ripsaw's sector analysis verifies the extreme underweight in MBS and corporate bonds associated with an all-government bond portfolio. Here is a flowchart of how Ripsaw Wealth Tools acquires and processes data. First, Ripsaw aggregates all your assets and liabilities into an online, auto-updated balance sheet that calculates the net worth that is the focus of your wealth portfolio. Second, Ripsaw accesses relevant data for the assessment of the risk-return characteristics on each asset and liability in your balance sheet. Third, Ripsaw aggregates these individual dimensions and their interactions into a wealth portfolio dashboard. Fourth, Ripsaw's wealth portfolio dashboard contains a comparison of risk-return characteristics with your custom benchmark for portfolio monitoring. Fifth, Ripsaw's revision mode provides the opportunity to examine the effects on your wealth portfolio risk-return dimensions from changes in the amount invested in each of your existing securities, as well as the addition of new investment alternatives. Note that Ripsaw does not execute trades for you. Ripsaw does not have any control of your accounts. It only accesses information relevant to constructing your wealth portfolio. Ripsaw contains a set of tools to help you make independent, informed decisions in your own best interest. Once you are comfortable with a set of portfolio revision decisions in Ripsaw, you execute those trade decisions with your financial institutions. Then go back to Ripsaw and refresh your balance sheet to see the results. Now let's play a very short video that illuminates the objectives of using Ripsaw Wealth Tools as an independent, low fixed cost, member subscription service.
We all want to have control of our financial future, to take care of ourselves, our family, and to do what we love. But this can get complicated. Anyone selling an investment product has a potential conflict of interest, and the interactions among many accounts and strategies seem impossible to manage. Robo and financial advisors miss your whole picture with cookie-cutter strategies. High fees and expense ratios diminish your wealth accumulation. Wealth portfolio management is often characterized as unattainable, time-consuming, and beyond our capabilities. We are changing that. Here at Ripsaw, we believe that you are the best person to be in control of your decisions. Ripsaw is an independent platform that provides a set of tools for you to make investment decisions in your own best interest. A customized benchmark establishes objectives, and the dashboard aggregates all assets and liabilities into a set of portfolio risk dimensions. Before executing any trades, evaluate what-if changes in your revised portfolio and its risk exposures relative to your benchmark. When your plan is suitable, execute trades in your brokerage accounts and see it afterwards refreshed in Ripsaw. Ripsaw is changing what it means to manage your wealth by putting you in the cockpit. Join Ripsaw and take control of your financial life. Sign up at ripsaw.co today for a free trial.